Hello friends, today we are going to start with contract of indemnity and guarantee forming part of your Indian Contract Act. Let us first see what is contract of indemnity. Contract of indemnity, which is defined under section 24. So what we'll do is we'll break up the definition into different parts and try to understand each leg of the definition. So let us see what does it say. It says a contract by which one party promises to save the other. So what do we understand out of this? A contract between two parties. So an indemnity contract is a contract between two parties by which one party promises to save the other party. So one party is promising to save the other party. So it is a contract you need at least two parties. So in case of a contract of indemnity, what we understand now is we need to have two parties. One in that contract, one party will promise to save the other party. From what? I have to save the other party from what? From any loss caused to him by the conduct of. So one party is going to save the other party. From what? From loss, some loss, which is caused to that party by the conduct of that loss. Why that loss has happened? We have to see now why that loss happened. So the loss happened by the conduct of whom? By the promiser himself. That means the party who is promising by his conduct or any other person. So this is the definition of contract of indemnity. So now we'll do a recap of the definition. So the definition says a contract between two parties where one party is promising to save the other party. Promising to save the other party from what? From some loss which is caused to that party on account of whom? Some action of the promiser himself, that is me or any other person. That is the definition of contract of indemnity. So basically, in case of a contract of indemnity, one party is trying to compensate the other party from some loss which may occur to him. Is basically the definition of contract of indemnity. We will discuss each and every part of this definition in detail. So indemnity is nothing but a security against loss. Any loss which may happen, I am trying to indemnify you. I am trying to save you from some loss which may happen to you. So now you may be thinking that this is something to a insurance. So yes, a contract of indemnity has similarity to a contract of insurance. We will also discuss that in detail. What is the difference between a contract of indemnity or whether an insurance contract is a contract of indemnity? We will also see that. So right now, for our understanding, we will see that a contract of indemnity, what happens? One party is saving other party from some loss. So it is basically a security against loss. Let us understand the concept. If you understand the concept, what happens in the exam? If your examiner wants to test you in whatever angles, we will be able to answer them easily. So let us try to understand the concept. So in a contract of indemnity, there are two parties. So which are the two parties? Party number one is your indemnifier. Party number one is indemnifier, or you can also call him as a promiser. So who is an indemnifier? Indemnifier is the person who promises. Is the person who promises, who is giving a indemnity. He is saying, boss, don't worry, if something happens to you, I will take care. If something happens, I will take care. I will save you from the loss. Who is that person? That person is called as an indemnifier or the promiser. He is promising to save. So please register in your mind, the first part is indemnifier, the person who undertakes to promise, or else the promiser. So who is this party? The party promises to indemnify or save the other party from loss. In other words, the promiser who agrees to make up the damage, caused to the other group is called the indemnifier. So, the person who agrees to assure him that yes boss, if in situation if something goes wrong I will take care of it, that promiser is called the indemnifier. So, now we understand first part is indemnifier, the person who promises, or you can alternatively call him as a promiser also. And who will be the second party? The second party will be your indemnified. So, indemnifier is the person who promises and the second party will be your indemnified. That means you can also call him as the promisee, the person who accepts the promise, or the indemnity holder, or the indemnity holder. So, this is the party to whom the promiser promises, boss, if something happens I will take care of. So, the party which is promised, he is assured to be saved from the loss. So, he is the receiving party. He says, so the promiser promises this indemnified, boss, if something happens I will take care of. In other words, the person who is assured of compensation for the damage which may incur is referred to as indemnity holder or the indemnified. So, he is indemnified means he is assured of some compensation in case of any loss which may happen in future. So, he is the indemnified, he is the indemnity holder, he has the indemnity in his hand. If something goes wrong, he will be taken care of. By whom? By the indemnifier. By whom? By this guy, that is the promiser. The promiser is promising him, boss, if something happens I will take care of. So, a contract of indemnity is a contract between two parties. Register, it is a contract between two parties. That is the indemnifier, the person who promises, and the indemnified, the person who accepts this promise, the person to whom the assurance is given that in case of any loss I will take care of you. That is the indemnified. He is the indemnity holder. He has this indemnity in his hands that tomorrow if something goes wrong with me, somebody will take care of me. And who is that somebody? That somebody is this indemnifier. So, two parties to this contract of indemnity. So, the term indemnity literally means security against loss. So, a loss which may happen, I am securing against that loss. So, in a contract of indemnity, one party is the indemnifier, other party is the indemnified. To indemnify means to compensate or make good the loss. Thus, under a contract of indemnity, existence of loss is essential. So, I may enter into a contract of indemnity. Boss, if something goes wrong with you, I will take care of it. But please understand, just because I have entered into a contract with you, which is a contract of indemnity, wherein I promise to indemnify you against a loss, please understand, a loss has to happen to indemnify you. Nothing happens, then why should I indemnify you? So, there should be a loss, some loss which should happen in the future. For that, if that loss occurs, then what will happen? Then I will indemnify you. So, to enforce a contract of indemnity, there should be an existence of loss. A loss should happen. Beautiful, clear, point taken? Yes. So, unless the promisee has suffered a loss, he cannot hold the promiser liable on the contract of indemnity. So, I cannot enforce the promisee or the indemnified. He will proudly say that I am the indemnity holder. Yes, you are the indemnity holder. But something should happen. The loss event has to happen. You should suffer some loss. Then only you can enforce this contract of indemnity. Indemnity depends on the happening of an anticipated loss. So, some loss I am anticipating, that only I can indemnify. So, it is a part of the general class of contingent contracts. It is the contingent contracts. So, it is a contract which is made to secure you against a loss which may happen. There is no guarantee. There is no guarantee that loss event may happen or not. But I am assuring you, if that event happens, it is a contingent event. What is contingency? Contingency is it may happen or it may not happen, it is not confirmed. So, it is not confirmed. if something happens, something goes wrong, I will take care of it. I will indemnify you, I will secure you, I will compensate you against that loss. We will now understand this contract of indemnity with the help of an example which will make things very clear for you. Mr. C is giving a loan of 10 lakhs. To whom? To Mr. B. So, C is giving a loan of 10 lakhs to B. Is there a contract of indemnity in this? Nothing is indemnity here. C is giving a loan to B. Then what is the contract of indemnity? What happens is now A comes into the picture. A comes into the picture. A says to B, if B fails to pay 10 lakhs, A will pay to C. If this B fails to pay the money, who will pay the money? A will pay the money. So, basically what is happening? What is happening in this scenario? A is saying, that is this party, that is A is saying that in case B doesn't pay you this 10 lakh rupees, then I will take care of you. So, who becomes the indemnifier and who is the indemnified here? Who becomes the indemnifier and who is the indemnified? You have to think now. So, the transaction is C gives the loan of 10 lakhs to B. Now, A comes into the picture and A says that if this guy, that is B, doesn't pay this 10 lakh rupees, then what will happen? A is saying, don't worry, I am there. Don't worry, I will pay you the 10 lakh rupees. So, definitely there is a component of indemnity here. So, who is the indemnifier and who is the indemnified? So, indemnifier is a person who is promising. So, who is promising here? A is promising. A is saying, boss, if anything happens, I will take care of you. So, who is the indemnifier? It is A. And who is the promisee? To whom he is promising? To whom he is saving from the loss. In the event of any loss in future, he is saving whom? He is saving this guy, that is Mr. C. So, what happens? It is a contract of indemnity. So, there is a contract of indemnity wherein A is the indemnifier and C is the indemnified. A is the promiser, C is the promisee. C is the indemnity holder. Tomorrow if something happens, tomorrow this B is not able to pay me the money. Who will pay me the money? A will pay me the money. So, in case tomorrow if I have some loss, who will take care of this loss? The loss will be taken care of by the promiser, by the indemnifier, that is Mr. A. Is the concept clear? So, this is example number 1. Let us see another example. X, a shareholder of a company, lost his share certificate. He applied for a duplicate certificate. Now, say for example, X is a shareholder of a company called as Reliance. Which company? Reliance Industries. And he has a share, but he has lost that certificate. See, in the olden days, we used to have manual certificates. So, he has lost that certificate. The share was bought by his father, his grandfather, whatever. He has lost the certificate and now he is applying for a duplicate certificate with Reliance. Boss, I have lost this certificate. He approaches the compliance officer of Reliance and he says to them, boss, I have lost my share certificate. Please help me out. Please give me a duplicate certificate. The company agreed to issue the same on the term that X will compensate the company against the loss where any holder produces the original certificate. Here, there is a contract of indemnity between X and the company. What is this? Now, this is an example of a share certificate. Now, you can extrapolate this example in any situation. In this situation, what happens? Let us see first. So, X, or assume you have a share of Reliance Industries and your physical share certificate is lost. Now, one share of Reliance is 2000 rupees. Single share of Reliance is 2000 rupees and assume you have 100 shares. So, 2000 into 100 shares is 2 lakh worth of shares you have of Reliance Industries. Will you just leave it like that? Definitely not. It's a huge money. So now you have rupees 2 lakhs worth of shares of Reliance Industries and you've lost the certificate. So what do? You approach Reliance. You approach Reliance and you say, Reliance boss, I have lost my certificate, but I am the rightful owner of that certificate. I am the rightful shareholder of your company. So please help me out. So what will happen? Reliance, after following all the procedures, after ensuring that you are the rightful owner of the shares, all that process will be followed. In spite of getting convinced that you are the owner, what will Reliance do? Reliance will also get a certificate from you. Reliance will also get a certificate from you. Why? To indemnify itself, to become an indemnity holder. Why? Because, say for example, you are Mr. X. You have 100 shares of Reliance. And what happens? You approach Reliance Industries. You approach whom? Reliance Industries. And Reliance Industries also allots 100 shares in your name by giving a duplicate certificate. Now tomorrow, what happens? Mr. Y, who is your brother, Mr. Y, who is your brother, also stand up and goes to say and says Reliance, boss, this 100 shares belongs to me. It doesn't belong to Mr. X. And how did you give this 100 shares to Mr. Y, Mr. X? Rather, it belonged to me. So there's a dispute involved here. So is the Reliance, is this the business of Reliance to find out who is the rightful owners? No. What Reliance will do is, after getting convinced that this share belongs to Mr. X, what it will do is, it will ask Mr. X to indemnify Reliance that tomorrow, if somebody else produces an original certificate for these 100 shares, then what happens? Mr. X will compensate Reliance. Mr. X will compensate Reliance. So this is a contract of indemnity, where Mr. X will say, boss, give me my shares, give me my duplicate shares, but tomorrow, be assured, don't worry Reliance, tomorrow if somebody comes with the original certificate, this 100 shares, they come with the original certificate, then in that scenario, I will compensate you for any loss which may happen to you. Who is promising whom? Mr. X is promising Reliance. Mr. X is nothing. Mr. X is nothing in front of Reliance, but Mr. X says, boss, you give my share certificates, I am the rightful owner of these shares. But tomorrow if something goes wrong, I will indemnify you against that loss. In particular to these 100 shares, you may have liability of 10,000s and lakhs of crores. I am not talking about that liability. I am talking about the liability with respect to this shares. This 100 shares I am talking about. If anything happens to you, because of this 100 shares, somebody comes and claims it from you, I will indemnify you. So there is a contract of indemnity between whom? Between X and the company, that is Reliance Industries. You can extrapolate this example into your practical life. So what happens? Now if you are helping out your family in the business, many times, say for example, your father is having a business of transportation. He is having a business of transportation, wherein he transports materials from place A, that is, say for example, from Chandigarh to, say for example, Gangtok. He is placing a vehicle to transport goods from Chandigarh. Chandigarh to where? Chandigarh to Gangtok. That's quite a distance. Now, he transports the goods and bills to whom? Bills to, say for example, Reliance Industries, saying the cost of the transportation, say for example, was 50,000 rupees and his margin is, say for example, 10,000 rupees, and he bills Reliance how much? He bills Reliance 60,000 rupees he bills. He says, boss, I have transported this material from Chandigarh to Gangtok and the freight charges for that is 60,000 rupees. Now, assume in this scenario, Reliance Industries or this transporter, he misplaces the POD. What is POD? Proof of delivery. So what happens is, when the materials gets transported from Chandigarh to Gangtok, and once the materials are delivered in Gangtok, the party will say, yes, received 5,000 tons of iron and steel from this transporter. It will give an acknowledgement, yes, you have delivered the materials safely to me. Now what this transporter will do, will take that acknowledgement, this POD, proof of delivery. He will take this proof of delivery and he will go to Reliance. Sir, I have delivered this material safely. Please give me my 60,000 rupees. So with this proof of delivery, what you will do? You will attach your invoice also. Proof of delivery is a supporting document. And then with this supporting document, you will attach your invoice and you submit to Reliance. Sir, give my 60,000 rupees. Now assume the driver is going from where? Chandigarh to Gangtok. Such a long distance. And what happens? He misplaces this proof of delivery. He misplaces this proof of delivery. Then what happens? Then can Reliance say, boss, I will not pay you the 60,000 rupees just because you misplaced this proof of delivery? No. So in that scenario, what generally happens? What generally practically happens is Reliance will say to this transporter that, boss, you have misplaced this POD. Then what you do is you give me a certificate of indemnity. You give me a certificate saying that tomorrow, if anything goes wrong against this consignment, tomorrow, say for example, the Gangtok party says that I did not receive the materials. In any such cases relating to this consignment, if there is any loss to me, then who will indemnify? This transporter will indemnify whom? Reliance Industries. So that is the concept of indemnity. So in our real practical life, we use it very, very often. So this is a very common example. Now, let's see example number 3. Now, Mr. Shyam contracts with government to return to India after completing his studies at University of Cambridge and to serve the government for a period of 5 years. See, Mr. Shyam is highly intellectual and he has been helped by the government in his studies or whatever it is, and based on that relationship, he enters into a contract with whom? With the government of India, saying that, boss, I will go for studies at University of Cambridge. I will go for studies at University of Cambridge and I will come back after my studies. I will not stay there. I will be a patriotic student. I will be a patriotic citizen and I will come back after my studies and work with the government. I will not join Infosys. I will not join Reliance. Instead, I will join the government of India and serve at least for a period of 5 years. This is what he agrees with the government of India. If Mr. X fails to return to India, he will have to reimburse the government. It is a contract of indemnity. So here also what happens? Mr. Shyam, he agreed in a contract saying that, boss, I will come and serve you back. But however, he fails on his promises, then he will have to reimburse the government. Now, example number 4. X may agree to indemnify Y for any loss or damage that may occur if a tree on Y's neighborhood property blows over. If the tree then blows over and damages Y's fence, X will be liable for the cost of fixing the fence. What is this? Now, say for example, there are two parties. If you see in the example, there are two parties. There is party X and there is party Y. So, who is the indemnifier and who is the indemnified? X may agree to indemnify Y. So, who is promising? Who is promising? X is promising. So, what happens? He becomes the indemnifier. And who is the promisee here? Who is given assurance? Y is given assurance and he becomes the indemnified, or you can say he becomes the indemnity holder. So, we have now identified two parties. These are the two parties. Now, for a contract of indemnity, there is a requirement of a loss, a contingent loss which may happen in the future. Now, in this example, which is the contingent loss? The contingent event, the loss which it says is, X says that tomorrow you have, say for example, this is his house. Now, in this house, there is a neighborhood tree and this tree is in a hanging position. Now, X says, boss, that is Mr. Y, tomorrow something happens and this tree, there is a tree here. Please excuse me for my drawing, but there is a tree here which is adjacent to this house of Mr. Y. And tomorrow something happens to this tree and this tree falls on your house. It damages your fence. Then what will happen? I will compensate you. I will take care of your costs. So this is a contract of indemnity because what? There are two parties, one is indemnifier, one is the indemnified, and what is the contingent event? The contingent event is the loss which may happen by the tree falling on the fence of Mr. Y. So this is again a contract of indemnity. So these are the examples which helps us to understand about what is a contract of indemnity. So basically a contract between two parties wherein one party agrees to indemnify, agrees to compensate, agrees to secure the loss of another party by an event which may happen in future. This implies that contract of indemnity does not cover loss. Now let us try to infer from this definition something. So if you recollect, in the first slide I said you, the loss may happen on account of the act of the promisor or any other person. Who is the promisor? Promisor nothing but the indemnifier or any other person. So if the loss has happened on account of these two people, then it's a contract of indemnity. So what does this mean? This means that if it is not a contract of indemnity, if the loss is on account of the following people: on account of conduct of the promisee. See, I agree to indemnify the other party for some loss. Now this promisee, he knows that if this loss happens, I will be compensated. So what he will do? He will purposefully do that loss to himself. Correct? So we are not covering the conduct of the promisee. If the loss event happens because of the conduct of the promisee, we are not going to say it is a contract of indemnity, which is logical. I am saying the tree will fall, or if the tree falls on your fence, I will compensate you. Now what will happen? The promisee, what he will do? He will go and cut the tree and make it fall on his house. Will it be a contract of indemnity? No, it will not be a contract of indemnity because the conduct is of the promisee. The promisee purposefully went and cut the tree. So is this point clear? Conduct of promisee. Loss caused by accident, not caused by any person. So any loss which is caused by an accident and which is not caused by any person is also not a contract of indemnity. And the third one is an act of God, that is any kind of natural calamity such as earthquake, floods, etc. So basically what we understand out of this is the loss should have been caused by the promisor himself or any other person, but not these three persons or not these three events. What are the three events? First one is the promisee, the conduct of the promisee. The second one is loss caused by accident, not caused by any person. If the accident is purposefully caused by some person, we'll have to investigate and find out who has caused that loss. And the third one is the act of God. We are not covering under contract of indemnity. Please register this in your mind. So the definition of indemnity itself, we are inferring this. This is not said by the act. The act does not talk about this, but this is inferred from the definition. The definition says the loss should have been caused by whom? The promisor or any other person. So definitely we are trying to say that. So it is not because of the conduct of the promisee or an accident or an act of God. Is this point clear? Yes. Now we'll go to the next point. Now comes the beauty. It says the contracts of insurance, that is like fire and marine insurance, will be covered under contract of indemnity. But please note, life insurance is not covered in it. That is, life insurance is not covered as a contract of indemnity. What are we saying here? We said here that the contract of indemnity, if it is because of the act of these three entities, then it is not a contract of indemnity. Which three entities? The conduct of the promisee, loss caused by an accident, and the third one is an act of God. But we are saying a contract of insurance, like a fire insurance, marine insurance, all this will form part of a contract of indemnity. But please register in your mind that life insurance is never a contract of indemnity. Why? Also we will discuss. So, of life insurance is never a contract of indemnity. We'll understand with logic. Let us not by heart, we'll understand with logic. So, here we come to the concept of indemnity versus contract of insurance. What is indemnity versus contract of insurance? So, here Mr. A, that is indemnified, Mr. A, that is indemnified, and what is the contingent event here? The contingent event is the loss by fire. And who is the indemnifier? Who is indemnifying Mr. A is the insurance company. So, in case of an indemnity, what did we say? Two parties. One will be the indemnifier. Who is the indemnifier? The insurance company is the indemnifier. It is saying, this insurance company is saying to Mr. A, boss, tomorrow if there is a fire, there is a contingent event. What is a contingent event? A fire. It may happen, it may not happen. Even in case if it happens to Mr. A, then what happens? Insurance company will take care. Will take care means it will save Mr. A from the loss which is caused by fire. So, does it fall into the definition of contract of indemnity? Yes, it falls into the definition of contract of indemnity. So, that is why we said a fire insurance like fire insurance, marine insurance is very much a contract of indemnity. But then we said a life insurance does not fall under a contract of indemnity. We will see why. So, to understand why life insurance is not a contract of indemnity, see, there are two types of policies. So, what are two types of policies? Life insurance and personal accident policy. What is the life policy? See, life insurance, what if you are aware what is the life insurance policy? What happens is, say for example, a person, once Mr. A, say for example, we will take the example of Mr. A. Mr. A clears chartered accountancy course. He clears the chartered accountancy course and he starts earning 10 lakhs per annum. So, now this life of Mr. A is very, very precious because his family is dependent on Mr. A. Tomorrow, something, God forbid, something happens to Mr. A. He loses his life by any reason. What happens? The family of Mr. A is deeply affected. So, that is why there is a concept of life insurance. Means tomorrow if something goes wrong, something happens to Mr. A and Mr. A dies, then what happened? The family of Mr. A is compensated. Now, I said Mr. A is a chartered accountant. His salary was 10 lakhs per annum. Now, similarly, say for example, Mr. B. Now, Mr. B is not a chartered accountant. He is a television actor and he is earning around 50 lakhs per month. He is earning how much? 50 lakhs per month. Now, if Mr. B dies, then also his family will be affected? Definitely yes. Now, just because Mr. A is earning 10 lakhs, Mr. B is earning 50 lakhs, can you value the life of Mr. A and can you value the life of Mr. B differently? Definitely not. The value of Mr. A to his family will be the same and the value of Mr. B to his family will be the same. Will it be possible for you to value Mr. A differently, Mr. B differently? It is very, very difficult because life is priceless. I cannot value a life. Now, if I have a car and the car catches fire or I meet with an accident, the car meets with an accident and what happened? The bonnet of the car is gone. So, I go to the car company, I say, boss, this bonnet is gone, please help me out. What happens? He will assess the car and he will say, boss, this bonnet has to be replaced and this will cost you 10,000 rupees. Valuation is possible? Very much possible, it is very easy. But if somebody dies, can you value him? It is not possible to value. So, what is life insurance? Life insurance is a contract wherein if something happens, a fixed amount is given to the family. So, in case of generally life insurance, what happens? Say for example, Mr. A chartered accountant dies. Mr. A will take a policy that tomorrow if something happens to me, you please compensate my family to the extent of 2 crores rupees. And for this, he will be paying a life insurance premium. Mr. B may insure his life for 10 crores. Now, this 2 crores and this 10 crores, does it mean the value of Mr. A is 2 crores? Does it mean that the value of B is 10 crores? No, definitely not. It is a predefined sum which Mr. A thinks that in the case of his death, if something happens to him, his family will at least need 2 crores to live their life. to live their life normally. So he decides this amount in his mind and takes the insurance. Whereas Mr. B, he thinks that my life needs much more luxury. So he thinks at least 10 crores is required by my family. So this amount is fixed. By whom? By the policy holder beforehand. So in case of life insurance policy, the amount is fixed. What is the amount? The amount of compensation is fixed beforehand itself, that in the case of death of this person, 2 crores will be given. In the case of death of this person, 10 crores will be given. So this amount is fixed beforehand. There is no need of assessment of the loss, how much loss has happened. This car has met with an accident. Can I just say this car has met with an accident and pay me 2 lakhs? I cannot. Say for example, we take car insurance. Say for example, the car is worth 10 lakh rupees. The car is worth 10 lakh rupees. So how much insurance will take? Will take for the value of the car for 10 lakh rupees. Now tomorrow, if the bonnet of the car is gone, I meet with an accident and the bonnet of the car is damaged. Can I go to the insurance company and tell them, boss, give me 10 lakh rupees? What will happen? He will laugh at you. He will laugh at you, or he will laugh at himself that he has such a customer. For bonnet, which is costing 10,000, is asking how much? 10 lakh rupees. So in case of a car insurance, what happens? The company will assess, okay, this bonnet is gone, this engine is gone, engine will cost at least 75,000 rupees, this bonnet will cost me 10,000 rupees, I will have to give him 85,000 rupees only. So the loss is assessed. So in case of this life insurance policy and personal accident policy, what happens? The amount is fixed in advance. I'm just compensating your family. Whether I am assessing the loss? No. But in case of other insurance policy, that is fire policy, theft insurance, marine insurance, what happens? I assess the loss. I determine what is the loss suffered by the entity, and then I compensate the loss. So in case of a contract of indemnity, it is if you remember the definition of contract of indemnity, we said a loss is compensated. It is a security against a loss. A loss has to be assessed. So in these other insurance policies, only the loss is assessed. In case of life insurance policy, I am not assessing the loss itself. The amount is predetermined. So this will never fall under contract of indemnity. Because in case of life insurance policy, so please understand, in case of an insurance contract, can you ever make a profit out of insurance? So for example, if the bonnet costs me 10,000 rupees, can I claim 25,000 from the company? I cannot, because the basic concept of insurance is I should not make profit out of insurance, which is never possible here. But in this case, I cannot say, because I do not know what is the loss, because value of life can never be measured and the amount is predetermined. If the event happens, I will give you 10 crores. If there is a personal accident, a death by accident, I will give 10 lakh rupees. It is fixed in advance. There is no assessment of the loss. So when I do not know what the loss, whether this person is making profit out of this policy, I do not know. So this will never form part of a contract of indemnity. So here a fixed amount is paid. Whereas in case of other insurance policies, loss is assessed, no profit out of insurance. There is no profit made out of this insurance. Because say for example, you have a theft insurance. A gold necklace worth 10 lakhs is lost. Then what happens? Can you claim 11 lakhs from the company? Definitely not. Because the value of that necklace was 10 lakh rupees. So you cannot make profit out of insurance is the basic concept. Hence, this is not a contract of indemnity, and this, that is your marine policy, your fire policy, your theft policy, all this will become part of your contract of indemnity. Is this concept clear? The concept should be very clear in your mind. Life insurance will never be a contract of indemnity. Why? Because in case of life insurance, life is priceless. You cannot measure the value of life. The amount of compensation is fixed in advance. Whereas in case of other general insurances, what happens? Only whatever loss has been incurred. So say for example, the car insurance, what is the car insurance amount? The IDV, if you have a car, if you have a two-wheeler, please go and check your insurance policy of your car. there will be an IDV value, insured declared value. What is that? The IDV value is nothing but, say for example, you bought a car for 10 lakh rupees. So 10 lakhs will be the IDV of the car, and every year you will keep depreciating it. So 10 lakhs only I will insure the car. So insured amount is how much? 10 lakh rupees. You will now pay the premium based on this 10 lakh rupees. It may be 20,000 rupees, it may be 30,000 rupees. Now in case of damage, can you ask the company to pay 10 lakh rupees? Definitely not. Only that amount of actual loss you can claim. Now say for example, if it's a life insurance, in case of a life insurance, say for example, the annual insurance, annual premium amount is 10,000 rupees and the coverage is 1 crore. Now tomorrow, if the death happens after 1 month itself, then what happens? The entire 1 crore will be paid, because that is amount fixed, which is predetermined in case of life insurance and personal accident policy. So this is the concept of insurance. So now you understand that marine policy, your theft policy, your fire policies, this will become a part of contract of indemnity. Now, what are the modes of contract of indemnity? So the Act envisages two ways. One is express and another one is implied. So again, it is very simple. We will see what is express. Express means if a person expressly promises to compensate, it is express, no need to think, no need to analyze. See what happens in the case of legislatures or laws. What happens? We interpret the law. We take inference from the law. We take inference from the case law. What was the intention of the act? What was the intention of the person who drafted the law? We try to analyze all that. That is not express. What is express? Express is, boss, you have told I intended to indemnify the other person. I very clear on this. That is express. So if a person expressly promises to compensate the other from losses, the mode of the contract will be expressed. So I am expressly saying, no question of doubt, nothing is there. No need to infer, no need to interpret this. It is very clear from the wordings. What is implied? What is implied? If the contract is signified, means the contract, I am reading the contract, and from this contract I am able to understand there is a contract, there is a intention to indemnify also. I am inferring, I am interpreting from the wordings of the contract. So it says, if the contract is signified from the conditions of the case or from the conduct of the parties or the circumstances, then the mode of contract will be implied. So the parties, the way they are behaving themselves, if it implies that there is an intention of contract of indemnity between them, then that will be implied contract of indemnity. So we have two modes, that is express and we have implied. Express means there is no need to interpret. It is clearly written that I intend, I wish to indemnify the other person. In case of implied, it is not clearly said. It is inferred, it is interpreted from their actions. That is implied. Now let us see some examples of this implied or expressed contract of indemnity. Example number 1. John had sold Paul a house at Peter's direction. So a house was sold at whose direction? At the direction of Mr. Peter. Afterwards, it is revealed that Alex is the house registered owner. So who was the actual owner? The actual owner was Mr. Alex. So now what happens? Now what will Alex do? Will Alex keep quiet? Definitely not. So Alex got back John's sum from selling his house. So whatever money which John had received, what happened? Alex got from John. Because who is the actual owner? The actual owner is Mr. Alex. So Alex, what he did? He went to Mr. John and he got his money because he is the real owner of the house. Now this Mr. John, he will now recoup Peter's fee. This is an implicit form of an indemnity contract. Means what happens here? Now this basically what has happened in this transaction, Alex was the real owner. So the entire transaction in effect has gone. The money which John had received has been now taken by whom? By Mr. Alex. because he is the registered owner. So now by this transaction, will Mr. Peter benefit? Definitely not. So whatever fees which Mr. Peter had got from Mr. John will be again taken back by Mr. John, and this is a implicit form of an indemnity contract. Tomorrow if anything goes wrong, because you are selling the house on whose direction? On the direction of Mr. Peter. On the direction of Mr. Peter, and then what happens if something goes wrong? Mr. John will recoup his fees. So this is a form of an implied contract. That means from the contract it is inferred that if something goes wrong, Peter will take care, because it was the entire transaction was taken at the behest of Mr. Peter, on Peter's direction. Okay. Now, Beta Insurance Company entered into a deal with Alpha Limited to reimburse the company's stock of rupees 50 lakhs for a premium of how much? Of 1 lakh rupees for damages by fire. So this is a explicit, so this is an express contract wherein I enter into a contract of indemnity with whom? With the Beta Insurance Company. Now, so now we have understood what is a contract of indemnity, and whether contract of insurance is a contract of indemnity. Yes, that also we have understood. Fire insurance, marine insurance, theft insurance, all this forms part of a contract of indemnity. However, life insurance and personal accident does not fall under contract of indemnity. We have also discussed in detail why it doesn't fall under a contract of indemnity also. So now let us see, we have already said that a contract of indemnity is a contract, it's a contract. So this should have definitely the basic elements of a contract. This already you would have studied, we will just do a recap. So a contract of indemnity is like any other contract and must fulfill all the essentials of a valid contract. All these points which I am going to discuss now, already you will know by heart. What it says? Offer and acceptance. There should be an offer and there should be an acceptance. Means I should promise, I promise to indemnify you, I promise to save you, and from the opposite side somebody should accept that promise also. If I promise to the wall, what is the use? There is an offer but there is no acceptance from the opposite side. So there should be an offer, there should be an acceptance. All this you already know, we are just doing a recap. So this forms part of your syllabus of your foundation, I believe, correct? So an essential element of a valid contract is what? There should be an offer and acceptance. One party should offer, other party should accept. Same thing is applicable for a contract of indemnity also. Intention to create legal obligation. Intention to create legal, there should be intention to create legal obligation. Now, I will talk with my friend casually many things. Will it create a legal obligation? Definitely not. There was no intention. Casually I may say it to my friend, tomorrow if India doesn't win, I will give you 5 lakh rupees. Will I give him 5 lakh rupees? No. So there should be intention to create a legal obligation. Otherwise, it is not a valid contract itself. Next, consideration. This is beautiful. So a contract should have a consideration, this we already know. Other than section 25, section 25 talks about exceptions. There are 3 exceptions for a valid contract without consideration. Otherwise, generally a valid contract should have a consideration. Now, in case of an indemnity, what is the consideration? If I agree to indemnify you against some loss, what is the consideration for me? Are you paying me something? See, if in case of an insurance contract, yes, premium is a consideration, very much valid. See, in case of an insurance contract, in case of a fire insurance, what happens? The company pays 10 lakh rupees premium to, say for example, New India Insurance. So that is a valid consideration which is paid, that I will pay you 10 lakh rupees insurance premium, you cover my stock worth 100 crores. So there is a valid consideration in case of an insurance contract. But let us talk about general indemnity. In general indemnity contracts, what is the consideration? should be a valid question which would have come to your mind. I said consideration is important. But say for example, in our example, say for example, I gave you an example that Mr. X agrees to indemnify Mr. Y if the tree falls on their fence, correct? Now, the contract is between whom? X and Y. X says tomorrow if tree falls, tomorrow means in future, if tree falls on your house, I will compensate. Now, what is the consideration which is received by X? Now, here that is the beauty. So, what you have to understand is, in this transaction, why will X agree to indemnify? Because definitely this tree which is adjacent to the higher house of Mr. Y has some significance to Mr. X. So, he is asking Mr. Y that don't cut the tree, tomorrow if it falls I will compensate. So, here the consideration is the act of Y not cutting the tree is the consideration. Is the concept clear? The concept here is, consideration means not necessary that I have to pay you 1 lakh rupees, I have to pay you 5,000 rupees. No. The consideration can be in the form of doing or restraining from doing something, also is a consideration. The act of doing something or the act of not doing something also is a consideration. So, in this example, see what is the contract? The contract was X said to Y that boss, tomorrow or in the future if this tree falls on your fence, I will compensate you. Yes or no? We said that it is a contract of indemnity. But where is the consideration? The consideration is indirectly, if you see this transaction, X does not want him to cut the tree. He is a nature lover. Mr. X is a nature lover. He doesn't want such a precious tree to just go off the axe. So, he tells Mr. Y, don't cut the tree, but suppose the tree falls on your head, not on your head, on your house, I will compensate you. So, it is a contract of indemnity. And is there a consideration? Yes, there is a consideration. Mr. Y is restraining himself from not cutting the tree based on this contract of indemnity which is given by Mr. X. Is the point clear? Yes. Competence to contract. Both the parties definitely has to be competent enough to contract. So, all your unsound mind, your capacity to contract points will come here. I am not going to elaborate on those points. Free consent. The parties in the contract should give a free consent. It should not be a forced consent. I make an offer, you accept it. Both the offer and the acceptance has to be by a free consent. It should not be a forced consent. Lawful object. The object should be lawful. I cannot tell you, boss, tomorrow you go and hit somebody. If then police comes you, I will take care of the police. Is it lawful? Definitely it is not lawful, because the object of going and hitting somebody, is it lawful? It is completely unlawful. Next will be, it must not be expressly declared to be void. Example, an agreement in restraint of trade or marriage, etc. So, any agreement when you restrain somebody from doing something, you cannot tell somebody don't do something. Again, that is not allowed. Now, but see, there is an exception to this. This already you know. Now, say for example, what happens is, say for example, Burger King. Burger King is now latest sensation because an IPO has come. So, now Burger King, suppose it opens in an area, say for example, Sarojini Nagar in Delhi. So, what Burger King will say is, do not open a store in and around 2 kilometers of this store. That is valid. But otherwise, you cannot have an agreement in restraint of some other trade. Now, must not be vague or uncertain. The agreement or the contract has to be very, very precisely clear. It can be expressed or it can be implied, that is fine. But it should not be confusing, it should not be vague, it should not be unclear, it should not be uncertain. So, don't think that I said that it can be implied. So, it can be vague also. No. A contract must not be vague, it must not be uncertain. It is very clear. The agreement must be capable of performance. So, it should not be a contract to do an impossible act. So, to do an impossible event. So, again that is not a that is an essential element of a valid contract is what? The agreement must be capable of performance. The task which you want to do should be capable of being done. It should not be an impossible event. Next is again legal formalities. All this already we know, these are the essential elements of a valid contract. These elements are applicable to indemnity contract also. That is it. Now let us see some example. So A contracts with B. A asks B, you go and damage the office of C. I don't like this C. So what you do is, don't kill him, don't murder him, you go and damage his office, at least do that. And then it says, A says, I will indemnify you for the consequence of the damage. See, when he goes and damages the office of C, what will happen? Police will come, police will catch him, police will catch Mr. B. So what Mr. A says is, when police catches you, I will take care of you. I will take care of the consequences. The promise of A cannot be enforced. This is an invalid contract since the object of the agreement is unlawful. Hence, if B is fined 25,000 rupees, he cannot claim it from A. He cannot say, no, Mr. A only told me to do. He promised me that if something happens, he will take care of. So this fine has to be paid by Mr. A. No, he cannot go and stand in front of Mr. A and say that, please give my 25,000 rupees. No, because this is an unlawful object. Point clear? Very, very simple. Now, rights of indemnity holder when sued, which is illustrated in section 125. So now, who is an indemnity holder? Again, it is the promisee or the person who is assured that if something happens to you, we will take care of you. He is the person who is assured. Who is the person? He is the person who accepts the indemnity. He is holding the indemnity. What are his rights when sued? An indemnity holder, that is indemnified, acting within the scope of his authority. He should be acting within his scope of authority. What does it mean? It is very, very important again. This Mr. A or whatever it is, Mr. Indemnity holder, he should act within his scope of authority, and then only he can enforce these rights which we are going to talk about. If this person doesn't work or is not acting within his authority, then he cannot enforce these rights. Now, I told you that I will indemnify you if this tree falls on your premises. But what I do? I go and I do something to ensure that the tree falls. So then what happens? Am I acting within my scope? No. I am going against the scope of my authority. So, if the indemnity holder is within his scope of authority, then he has some rights. And what are these rights? Claim damages. Recover all damages which he might have had to pay in a suit in respect of any matter covered by the contract. So, this indemnity holder can recover all the damages which he has paid in any suit on account of this loss. He can claim from whom? From the indemnifier. Then, he can recover all costs incurred in the suit also. So, if there is a legal dispute which goes on because of this loss, then any cost which I incurred, I means the indemnity holder, he may incur many costs. So, even this cost also may be recovered from whom? From the indemnifier. And sums paid under compromise. Sums paid under compromise recover all amounts which he had paid under the terms of the compromise of such suit. However, this must be prudent and authorized by the indemnifier. So, this indemnity holder. So, this is the advantage of this contract of indemnity. So, tomorrow if something goes wrong and provided I have acted within my scope of authority, then I am entitled to these things from whom? From this indemnifier. Boss, because of this loss, if there is some damages which I have to pay, some cost which I have to incur, or some amount which I have to pay under compromise, then all this I will recover from whom? From the indemnifier. This is section 125. So, indemnity holder is entitled to sue for specific performance if incurred absolute liability and the contract covers such liability. So this indemnity holder, see, it's a valid contract. The contract of indemnity is a valid contract. So he is entitled to sue for specific performance in event of he has incurred an actual liability. So this indemnity holder, if he incurs some liability, then he can enforce specific performance of this liability by whom? By the indemnifier. This point clear? Section 125. So section 125 says, in case the indemnity holder is acting within his scope of authority, then what happens? He can claim the damages, he can claim the cost, and he can claim whatever amount he has paid under a compromise, all from the indemnifier. Now, the promisee. Now, who is the promisee? All this should be in your mind. Promisee is nothing but the indemnified. So, the indemnified in a contract of indemnity, acting within the section 25 of the Act, only lays down the rights of the indemnified and is silent on the rights of the indemnifier, as if the indemnifier has no rights but only liability towards the indemnified. So, if you see here, when we see section 125, we now spoke about the rights of the indemnified, that is the person who is a promisee. So, does it mean the promisor does not have any rights? It looks like that from section 125. It looks like that only the indemnifier has only liability. He doesn't have any rights in case of a contract of indemnity. But it is not like that. It is not like that. So, it says, in the logical state of things, if we read section 141, which also we will read as part of this chapter, it says, section 141 deals with rights of surety. We can easily conclude that the indemnifier's right would be same as that of a surety. See, you will understand this paragraph once we go to contract of guarantee. Then you will be able to understand this very clearly. Here, now, don't confuse yourself. In case of a contract of indemnity, there are two parties, the indemnifier, the indemnified. So, now we have understood what are the rights of the indemnified, that in case of any loss, he can recover from the indemnifier. That we have understood. Recover all cost, recover damages, recover any amount paid for a compromise. We can recover everything from whom? The indemnifier. We have understood. But the section has not said anything about the rights of the indemnifier, whether he has any rights or not. So, what we are saying is, he has rights. Don't worry. When we go to section 141, section 141 talks about the rights of a surety, and those rights may be applicable to the indemnifier also. So, nothing to worry, even the indemnifier will have rights. We can see for the rights of a surety which will be applicable to the indemnifier when we go to section 141 of the Act. Okay. Now, so commencement of indemnification. The Indian Contract Act 1872 is silent on the time of commencement of the liability of the indemnifier. When will the liability commence? So, on the basis of the judicial pronouncements, it can be stated the liability of indemnifier commences as soon as the liability of the indemnity holder becomes absolute and certain. So, the moment the event happens, the moment the liability becomes absolute and it becomes certain, what happens? The liability commences for the indemnifier. So, this is about the concept of contract of indemnity. We have understood what is the concept of contract of indemnity. We have understood what are the valid essentials of a contract of indemnity. We will now continue with the contract of guarantee in the next learning unit. Thank you.